It takes us to our talk of the tape, new records and what's next for stocks. Let's ask the panel. Stephanie Guild is Robinhood's head of investment strategy. Cameron Dawson, chief investment officer with NewEdge's Wealth. Ayako Yoshioka with the Wealth Enhancement Group. Welcome, everybody. It's good to have you with us. All right, Cam, you first. Chopped a lot of wood over the last couple of weeks. Now we're on this swing higher, today notwithstanding. How do we feel about the markets?
We're sitting right near or right at that all-time high. We've moved a lot in the last 8 days, but I think the important thing to note is that there has been a very pro-cyclical risk-on tone to this market. Look at things like cyclicals outperforming defensives, high beta outperforming. That's a very good thing for risk appetite. The thing to watch is there's a little bit of a breadth divergence, meaning that we didn't get that typical kind of breadth thrust coming out of the low off of that 100-day moving average. So maybe there's a little bit more volatility in wood to chop, but of course earnings season coming in better than expected helps on the fundamental side.
All right, Stephanie, no tariffs, no problem. I mean, is that the baseline of how we should view things, at least for the moment?
No, I think tariffs will definitely, I think they could come for sure, and we need to be careful about that. But there are also a lot of good things that are coming out. Like, I think deregulation as part of this administration is really driving markets. The IPO today, all of those things. And while I don't completely agree on the breadth, Mark, because we're seeing mid caps are outperforming and small caps doing better, and you're seeing industrials, even industrial production come in very strongly. So I think there's a lot of optimism. You
think this is the moment for a real and legitimate broadening that actually lasts for a while? We've had this before. It just hasn't lasted.
Yeah, I do, but I think that the risk in it is that we haven't actually dealt with the hard problem, which is interest rates in our deficit. That still hasn't come up in government yet. It's all the kind of good things that through executive order.
But rates have come off the boil a little bit. To Stephanie's point, we're worried about tariffs and we're thinking about the deficit and we're worried about the Fed not cutting as much as we wanted to. But as long as rates stay off that burner, are we all right?
I think so. In 2025, I think the Fed's not going to be as front and center as it has been over the last couple of years. They're on pause, and so it allows a lot of the companies within the S&P 500 or, across small and mid-cap space for their earnings to do the heavy lifting. And so we expect that to continue to be the case in 2025.
I know there's a lot of optimism, and it's for good reason. It's for the deregulation that Stephanie talked about. It's for the tax cuts that many expect. It's a more pro-business environment. Doesn't mean that there, of course, aren't any risks like the ones that Larry Fink was talking about with our own Sarah Eisen out in Davos about what might happen and what to watch out for. Listen.
If you expand that throughout the world, this is my optimism about growth, but at the same time, we actually are going to have labor shortages, which is going to be driving up wages. I think we're going to see more persistent wages, and that may be a good outcome, but it's going to be an inflationary outcome. We're going to have material shortages with all this building out. And so I think we are somewhat complacent that inflation can hit us again.
And Cameron, Larry Fink gets paid a lot of money to worry about that kind of stuff, and others in the banking industry have talked throughout the last couple of years about similar risks. Are we too complacent about inflation coming back, in part because of Trump 2.0 policies?
I think we have to appreciate the uniqueness of the last 2 years that allowed inflation to moderate without having it impact growth. The fact that you had a big surge in low-cost labor come into the U.S., you had a productivity surge coming out of the worst of the COVID low, all of that led to this ability to be able to see disinflation without it impacting growth. But we still have this tight labor market. If you start reducing immigration, if you add tariffs, which can cause disruptions to supply chains, and you start spending more money, and even if you add on top of that the potential that the Fed could continue to cut rates, you set up for an environment where inflation could be a lot stickier and not get to that 2% target.